Welcome, curious minds, to another deep dive. Today, we're unpacking a fresh set of sources that paint a really compelling picture of a major player in the industrial sector, Welspun Corp Ltd. Think of this as your shortcut, really, to understanding a complex company's latest strategic moves. We're plunging into their recent Q1 FY26 financial results. We've got the official press release, the investor presentation, and the certified financial reports. Our mission: to pull out the key nuggets of knowledge, look at their strategy, and figure out what it all means for them and, the wider market. We're trying to see how this industrial giant isn't just growing, but maybe reinventing itself, signaling some bold new directions.
Absolutely. And what's really fascinating here, I think, is how these results show a clear strategic evolution. They're moving well beyond just their foundational business. We'll get into the headline numbers, of course, but maybe more importantly, we'll connect them to the bigger industry picture and the company's pretty ambitious expansion plans. You'll see how even, within just one quarter, a company can signal some pretty significant long-term shifts.
Okay, let's get into it then. Let's unpack this. So starting with the big news, right? Welspun Corp reported its highest ever quarterly EBITDA for Q1 FY26. That's quite a headline. But does that growth really show up across the board, like total income, profit? What do those tell us?
Well, it's definitely a powerful statement, but yeah, it's backed up. The Q1 FY26 EBITDA hit Rs 560 crore, and it shows this consistent improvement over the last, 5 quarters. So this isn't just a blip, it feels like a trend. And if you look at their annualized return on capital employed, the ROCE, it stood at about 24%. That's pretty impressive.
Yeah.
Shows they're using their capital effectively.
Right, 24% is strong.
Yes, sir. Yeah.
And the year-over-year growth, those percentages look pretty striking too.
They really are. For Q1 FY26, total income grew around 13% year over year. EBITDA was up even more, roughly 35%, and profit after tax PAT jumped by a remarkable 41% year over year. Yeah. And the strong performance, it lines up directly with their own full-year guidance for FY26, which, in an industry that can be pretty volatile, hitting or exceeding your own ambitious targets, that signals, I think, a really good handle on the market and execution. It's a real edge.
Okay, so the growth numbers are compelling, but let's look underneath, the financial health, right? How are they actually managing to fuel this kind of growth? Are they taking on a lot of debt?
That's the key question, isn't it? How do you grow like this but stay stable? Well, big part of it is their order book. It's valued at around Rs 19,000 crore. That's basically guaranteed future revenue. It covers line pipes in India and the US, ductile iron or DI pipes, those are the heavy-duty ones for water mainly, and stainless steel stuff. But what's really notable, I think, is their US mill. It's apparently booked solid for the next 2 years.
2 years.
2 years. That gives them incredible revenue visibility, much more than many competitors probably have.
Okay, that's significant visibility. You mentioned stability. They managed to stay net cash positive even with big investments. How was it? Just super tight cost control?
It really points to their strong operating cash flows. I mean, they spent around Rs 450 crore on CapEx, capital expenditure, just in Q1. That's a lot.
Yeah.
But even with that, they maintained a net cash position. They had about Rs 600 crore in cash and bank balances. If you look at the bigger picture, that shows really careful financial management. They're funding growth from their own operations, not piling on debt. That positions them really well.
And others noticed this financial strength too, didn't they? The rating agencies.
Absolutely. CRISIL upgraded their long-term bank facilities and their non-convertible debentures. They went up to AA+ with a stable outlook.
Which was up from AA positive, right?
Exactly. And their short-term facilities stayed at A1 plus AG, which is the highest rating you can get for safety. And the reason CRISIL gave, well, it was things like their diversification, the strong cash flows we just talked about, their sort of modular investment plans, and just their leading position globally in line pipes. So yeah, this upgrade, it signals real confidence in their stability and their growth strategy. It's a strong outside validation.
Okay, so they're performing well, they've got cash, they've got a strong order book. Where are they putting that strength to work? The investor presentation mentioned a huge investment plan over Rs 5,400 crore through FY27.
Yeah, it's a major commitment. And these strategic investments, they're spread across their main areas: India, the US, and Saudi Arabia, KSA. So, for example, they're putting serious money into new pipe plants in the USA, HFIW, and LSO types. Those are due by March and December 2026.
And those are for the big energy projects, right?
Right, large diameter, high strength pipes. And then in KSA, they're building new DI pipe and LSAW plants, aiming for completion by April 2026. These are all about adding significant capacity where they see growing demand.
So how does the current market look in those places? Does it justify this kind of expansion?
Well, let's take the USA. The outlook for line pipes seems pretty robust there. It's driven by a current focus on oil and gas. Crude production is projected to rise, LNG exports too. And like we said, their U.S. mill being booked for 2 years, that speaks volumes about the demand they're already seeing.
Makes sense.
Then in India, you've got strong demand for LSAW pipes, and there's potential building in newer areas like hydrogen and carbon capture pipelines. That's still early days, but important for the future. Plus, domestic oil and gas demand is expected to basically double by 2050. The government's investing heavily in refining and pipelines. And the city gas distribution sector, the CGD, that's also set for big growth, so steady demand there.
Okay. And KSA.
For KSA, water projects, transport, distribution, that's a constant focus. But they also have these ambitious plans to boost oil production capacity way up beyond 13 million barrels a day. That will definitely drive demand for line pipes.
So beyond the traditional line pipes, they're clearly pushing into other areas too. What's going on there?
Right, diversification. Their stainless steel bars and pipes and tubes business in India, it actually hit an all-time high for bar sales volume in Q1. And they got this AS9100D accreditation. That's a big deal for aerospace applications.
High value stuff.
Exactly. High value, high margin potential. It opens doors. Then there's DI pipes. The Indian market expects huge volumes, like 2-3 million tons from big irrigation projects, think river interlinking schemes. They did see a bit of a slowdown in Q1 apparently, but their DI order book is still substantial, about 307,000 metric tons. And their new plant in KSA is moving ahead, and they expect anti-dumping rules there to help local production.
Okay, and then the elephant in the room maybe? Syntex, that was a huge acquisition, right? A real move into a different space. How's that actually playing out now? Are we seeing results yet?
Yeah, Syntex. This is where it gets really interesting, I think, and shows the long-term play. By buying Syntex BAPL, which is, a leader in water tanks and plastic products, Welspun massively expanded into building materials. They launched new pipes in Chhattisgarh back in May 25. Their Bhopal plant for OPVC pipes should be running from Q2 FY26. Strategically, it's huge. Their total addressable market, or TAMISM, it jumps from about Rs 12,000 crore to Rs 85,000 crore. That's with both water tanks and the new pipes business.
85,000 crore.
Massive leap in potential. This
Yeah.
is really where you see that transformation narrative. They're moving beyond just big industrial pipelines into products that are, well, much closer to everyday consumers.
That potential is undeniable. But looking at the segment results, the other segment, which includes these plastic products, it actually showed a loss in Q1 FY26. How do we square that circle? Is that a worry or just growing pains?
Right, that's a fair question. It raises that classic issue of initial investment versus long-term payoff. So yes, the others segment reported a loss, about Rs 8.66 crore for Q1 FY26, but you absolutely have to see that against the backdrop of the huge upfront investment. They're putting Rs 1,300 crore into Syntex, staggered from FY25 to FY27.
Okay.
So this segment is really still in its infancy, right? They're building out channels, doing brand work, getting new plants online. It's not unusual to see losses in the early phase of such a large-scale market entry and diversification, especially when you weigh it against that massive increase in the potential market, the TAM. The focus here seems clearly long-term. Capture the market, build value. That loss looks like a calculated cost of entry.
Got it. So an investment phase loss, basically. Makes sense in that context. Now, shifting gears slightly, but still important.
Yeah.
Sustainability. It's good to see big industrial companies focusing on this. What did the sources say about their ESG efforts?
Yeah.
And are there big challenges there?
Yeah, their commitment seems pretty clear. They improved their S&P Global DJSI ESG rating score by 6% recently, and they're ranked in the top 10 globally in the steel sector for ESG. They've set some ambitious long-term goals too. Carbon neutrality by 2040, water neutrality also by 2040, and zero waste to landfill.
Those are big targets.
They are. It shows they're integrating ESG into their core strategy, which reflects that broader industry push towards responsible growth. The challenge is, well, for a company this size, scaling up renewables, implementing advanced water recycling everywhere, ensuring supply chain transparency, those are definitely complex hurdles. But hitting those targets is key for long-term value, I think.
Okay, so let's try and pull this all together. What's the main takeaway for you, our listener, from this deep dive? We've looked at a company that's clearly not just growing its core business, but seems to be strategically transforming itself, expanding globally, and pushing hard into new product areas.
Yeah, if you zoom out, Welspun Corp's Q1 results show a company that's executing really well against its own plans. They're capitalizing on strong demand in their main sectors, and they're making these calculated pretty bold bets on new segments like the Syntex plastic pipes business, the strong financials, that really solid U.S. order book, the credit rating upgrade. It all points to a company building for sustained growth, even while managing the, early costs of these big new ventures.
So this deep dive really highlighted a company balancing its established strengths with some pretty bold new moves, trying to redefine itself maybe. As you watch the market, perhaps think about how other traditional industrial companies are trying to diversify. And what do those initial investment phases look like for them? It's often not smooth sailing at first.
And maybe a final thought for you to mull over. As companies like Welspun massively expand their total addressable market through these kinds of acquisitions and new products, how does that shift not just their bottom line, but their actual identity, their place in the competitive landscape over the next 5, 10 years? It really raises that interesting question about the long game of industrial transformation. How do you fundamentally change while still delivering day to day?
Definitely something to think about. That's it for this deep dive. We hope you feel a little more well-informed and definitely more curious.